This company sells products in more than 200 countries, and there's a very good chance you consumed something from it in the last 24 hours without even realizing it. Most people think PepsiCo is just a soda company. That's exactly why they underestimate it. Because the real engine behind PepsiCo is not just drinks. It's snacks. And once you understand that, the whole company starts to make a lot more sense. To see how PepsiCo became such a powerhouse, you have to go back more than a century. The Pepsi side of the story starts with a pharmacist named Caleb Bradham in North Carolina. In 1893, he created a drink called Brad's Drink. Later, he renamed it Pepsi-Cola. The name came from dyspepsia, a word tied to indigestion, because Bradham believed the drink could help with digestion. But that's only half of the story. Because PepsiCo didn't start as one company. It started as two separate businesses that eventually collided in a way that changed everything. On the snack side, Charles Elmer Dulin bought a corn chip recipe in Texas in the early 1930s. That purchase helped launch what became the Frito brand. For years, Pepsi and Frito grew separately. Then in 1965, Pepsi-Cola and Frito-Lay merged to form PepsiCo. And that was the moment the company became something much bigger. Not just a beverage company. Not just a snack company. A company that could sell both at the same time. And that turns out to be one of the smartest business models in consumer goods. Here's the key idea most people miss. PepsiCo is not built around soda. It's built around distribution, scale, and shelf space. The company usually gets broken into three big parts: Frito-Lay North America, PepsiCo Beverages North America, international businesses across different regions. And if you look closely, the snack business is one of PepsiCo's biggest strengths. Why? Because snacks tend to be sticky. Once people find a chip they like, they usually keep buying it. Lay's, Doritos, Cheetos, Ruffles. These are the kinds of products people reach for without thinking too much. That matters. Because repeat behavior is powerful. It gives PepsiCo a strong base of demand and helps support margins over time. The beverage side is still huge, of course. Pepsi, Mountain Dew, Gatorade, Tropicana, Aquafina. These are major brands with global reach. But beverages are a tougher fight. Competition is intense. Consumer preferences shift faster. And price pressure can be harder to manage. So PepsiCo's real advantage is not just that it sells drinks. It's that it sells drinks and snacks together. That bundle creates a lot of leverage. Retailers can source more products from one company. Logistics get simpler. Shelf placement gets stronger. And PepsiCo gets a deeper relationship with the store. That's a major reason the company has stayed so durable for so long. And it doesn't stop there. PepsiCo's products are sold in more than 200 countries and territories. That kind of reach doesn't happen by accident. It comes from a massive supply chain, a deep distribution network, and years of building relationships all over the world. Now let's talk about what that means for the stock. PepsiCo is not the kind of company that usually makes headlines for huge upside. It's not a moonshot story. It's something different. It's a company built to keep producing. That's why long-term investors like it. They're not usually buying PepsiCo because they expect explosive growth next quarter. They're buying it because they want a business that can keep delivering year after year. And in the world of consumer staples, that matters a lot. Because boring businesses can be incredibly valuable. When the economy gets shaky, people may cut back on travel, electronics, or big purchases. But they usually keep buying snacks and drinks. That gives PepsiCo a level of stability that many companies would love to have. It also helps explain why the stock is often seen as defensive. Defensive doesn't mean exciting. It means resilient. And in a rough market, resilience can matter more than hype. Another big reason people pay attention to PepsiCo is the dividend. This is one of those stocks that income investors know well. It has a reputation for steady shareholder returns, and that makes it appealing to people who want more than just price appreciation. For many investors, PepsiCo fits a simple formula: solid business, strong brands, reliable cash flow, ongoing dividend income. That's not flashy. But over time, it can be very effective. Especially for investors who want to compound wealth slowly instead of chasing the next hot name. And in a market full of dramatic stories, that kind of consistency can be easy to overlook. Of course, PepsiCo is not without problems. And this is where the story gets more interesting. Because the same company that looks stable on the outside is facing some real pressure underneath. The first challenge is health trends. Consumers are paying more attention to what they eat and drink. That means more demand for low-sugar beverages, simpler ingredients, better-for-you snacks. That puts pressure on some of PepsiCo's core products. The second challenge is pricing. PepsiCo has leaned on price increases in recent years. That can work for a while. But only for a while. Because eventually consumers push back. And when that happens, volume can fall. That's a dangerous trade-off. The third challenge is competition. PepsiCo faces Coca-Cola in beverages. It faces global food companies in snacks. And it faces private label brands that can often undercut it on price. That matters more than a lot of people think. Because if a shopper can get something similar for less money, loyalty gets tested fast. Then there are cost pressures. Raw materials, packaging, transportation, fuel. Even a giant company like PepsiCo can't escape those forever. And because it operates globally, it also has to deal with currency swings, political risk, and supply chain disruption. So yes, the business is strong. But it is not simple. And that's exactly why investors keep watching it so closely. PepsiCo is also a long-standing S&P 500 company. The index itself was introduced in 1957, and PepsiCo has become one of the familiar names inside it. That matters for a simple reason. When a company becomes part of a major index, it usually attracts long-term institutional attention. It also ends up inside a huge number of ETFs and index funds. So PepsiCo benefits from more than just brand recognition. It benefits from structural demand as well, and that helps explain why it has remained such a stable presence in the market. Now here's the part that makes PepsiCo interesting. Even with all these challenges, the company is still trying to evolve. And that evolution matters. The bull case starts with healthier products. PepsiCo has been expanding zero-sugar drinks, reduced-calorie options, and better-for-you snacks. That is not just a trend. It's a necessity. If the company wants to stay relevant long-term, it has to meet consumers where they're headed, not just where they've been. The next opportunity is emerging markets. This is a big one. As middle classes grow in places like Asia, Africa, and Latin America, demand for packaged food and branded beverages tends to rise too. That gives PepsiCo a long runway if it can keep executing well. Then there's brand power. This is one of PepsiCo's biggest advantages. Few companies have this many globally recognized names in one portfolio. That gives it pricing power, customer familiarity, and a level of trust that is hard to build from scratch. And finally, there's efficiency. PepsiCo keeps investing in automation, supply chain improvements, and cost control. Those things may not sound exciting, but they matter a lot. Because in a business like this, small efficiency gains can protect a lot of profit. And then there's the shareholder side. PepsiCo is still known for returning cash to investors. That makes it appealing to people who want a mix of growth, income, and stability. So what's the real debate here? It's not whether PepsiCo is a strong company. It is. The real question is whether it can keep balancing both sides of the business. Can it protect its snack dominance? Can it keep beverages relevant? Can it adapt fast enough to changing consumer habits? Can it defend margins while costs stay high and competition keeps rising? Those are the questions that will shape the stock going forward. Because PepsiCo's past tells you a lot. But it doesn't guarantee the future. A company this large can stay strong for a long time. But it also has to keep moving. And that's the tension at the center of the story. PepsiCo is a company built on consistency. But consistency alone is not enough. It has to keep adapting. Its strengths are obvious: strong brands, global reach, and dependable cash flow. Its risks are just as real: changing consumer tastes, pricing pressure, and rising competition. So the question is simple. Can PepsiCo keep evolving fast enough to stay ahead? Or is the pace of growth starting to slow? What do you think? Is PepsiCo still a long-term winner? Or is the market underestimating the challenges ahead? Thank you for watching.